And right now we put the focus on a report titled Fueling the Dragon, Natural Resources and China's Development. Joining me in studio for this discussion is Terence McNamee. He's of the Brenthurst Foundation. Thanks so much for joining us this morning. Terence, let's get straight into this conversation because we've been talking about China and whether or not them stimulating that economy is going to have any impact on resource demand in the short term. Yes, certainly in the long term, but it also brings to question the kind of reliance African economies and resource-based economies place on growth in China specifically.
Absolutely. So Africa, as we all knew, grew about an average of 5% over the past decade. And much of that was on the back of China's demand for Africa's resources. So about 2/3 of Africa's total trade is comprised of fuels and mining products. And we think that about, well, a very significant percentage of Africa's growth in the 2000s was based on higher revenues from natural resources. The problem is that during that time, Africa has not diversified, it's not done a very good job in terms of beneficiation. So it's very reliant and it's very also vulnerable to any downturn in the Chinese economy.
This is not a new conversation. We've been having this conversation for years. Why the lack of change or why the slow to evolve for African economies specifically?
Well, I think it's probably down to leadership. It's down to short-sightedness. It's down to a failure to implement those kind of policies and those frameworks that we've seen in countries like Norway and so forth, that have used their natural resource endowments much more wisely than Africa has in general. But it's a critical time for Africa because those price-sensitive commodities we've seen in countries like Australia, much more advanced countries than African countries, that they are also extremely reliant, for instance, on their iron ore exports to China, which comprises almost 20% of Australia's all of their exports. And so have we seen the downturn and the fall in iron ore prices has really affected the Australian economy. Yeah,
let's take a look at, you mentioned more advanced economies, and that's often used as a reason as to why African countries aren't getting it right, is that we're just not able enough. Is that a good enough excuse?
No, it's absolutely not good enough excuse. We've seen a lack of investment in those critical things to diversify Africa's economies. Skills and training. We have not seen Africa move away from these very price-sensitive commodities and look at capitalizing on those opportunities, those preferential trade agreements. China has made a pledge that 97% of Africa's exports to China will be duty-free by 2015. So where are African countries capitalizing on those opportunities, developing those products to leverage those opportunities? And we haven't seen that yet.
It's also because very often you've got African countries that aren't singing off the same hymn sheet. I mean, you mentioned preferential trade agreements. There's been a lot of arguments as to, what a country is willing to buy into and perhaps that the next country is not.
Precisely. So we've seen in a country like Lesotho, which its employment has risen significantly on the back of the African Growth and Opportunity Act that the United States implemented. Now, fortunately for Lesotho, they've extended that to 2015. But what's going to happen to a country like Lesotho, and particularly its textile sector, when that agreement expires? Because we've seen that Lesotho, like other countries, has not catalyzed on that opportunity that AGOA presented, and it's not diversified beyond the textile sector. So we're not only going to see a fall probably in terms of textile exports from Lesotho, but we're also going to see a gradual downturn in the whole economy, which is very, very vulnerable to any economic downturn, whether it's in the United States or China.
Of course, this is a discussion that was had between the 17th and 19th of May this year over in Zambia, where we had experts and policymakers from Africa, Latin America and elsewhere just joining this conversation. What's leadership saying?
Well, I think African leadership, it's a bit of a mixed bag. We've seen countries that are starting to get a little bit smarter in terms of their deals with China. And one of the interesting countries to look at is Angola. Now, we all know that Angola is China's biggest trading partner in Africa. It's the third biggest supplier of oil to China. And Angola has done some interesting things in terms of housing and so forth, in terms of capitalizing on that relationship with China in terms of building infrastructure. Now, it's by no means a great story across the board. There's many, many problems to that. But we've seen signs that Angola has a sense of its own national interests. And that's been one of the major problems, is that every 3 years there's a massive summit in China, the Forum on China and Africa Cooperation. And what we see is that China makes these extraordinary pledges to Africa. The most recent pledge was $20 billion in loan. But on the African side, we don't see a coherent agenda. We don't see their own priorities. What do they want to get out of their relationship with China? And to date, they haven't really formulated a coherent approach to the China relationship. And that's why we've seen the lack of the development dividend that we should have expected on the back of this economic growth and the back of China's demand for Africa's resources.
Of course, this is a topic that's made headlines. I mean, looking at the Sunday newspapers just this past Sunday, a major headline that was run across the Sunday Times was how China bleeds South Africa dry. And where you talk about African countries not perhaps having their national interests as much at heart as they need to have them. What do you see this relationship, evolving relationship with South Africa and China evolving to as a member now of BRICS? Does that voice get any louder?
Well, I think that the type of headline that you just cited feeds in, I'm afraid, to the myths about China and Africa. And one of them relates to manufacturing. Yes, the textile sector in Africa and in South Africa has been negatively affected by the increase, the flow of cheap Chinese-made goods. But in general, the research suggests that manufacturing as a whole has benefited from Chinese involvement and engagement. And I think South Africa, as we know from the financial sector and so forth, the extent to which Chinese companies and banks have bought into the financial sector, to date, it's a net benefit for South Africa. There's no question about that. But we shouldn't be looking to China in terms of how we've lost jobs and so forth. We should be thinking about what we should be doing to be not only competing against China, but to become the new China, in the sense that China is moving from the low-income bracket to the middle-income bracket. And as it does that, its labor costs are rising. So it's presenting an opportunity for some countries, if they get that formula of policy and regulatory frameworks right, to really move into those type of light, low-tech industries that are strong in poor environments. So, you know, some African countries, there is that opportunity to be the new China.
Of course, it's all about putting the right mechanisms in place to leverage off the opportunity that China does bring to the relationship. Thanks so much for joining us, Terence, this morning.